Hello, today we're going to talk about something that I think is probably one of the most important videos I've ever done, and I think we'll look back on this as really timely, and hopefully you can share this with other people that might be able to benefit. Right now, March of 2021, we're seeing record home prices just off the charts. The numbers are unbelievable. The increase in values are bigger than I think we've ever seen. Even during the rise in 2006 and 2007, I don't think we've seen this quick of a move up in home prices. We're seeing multiple bids on properties. Properties are getting listed and they're selling for over asking price and on multiple bids. And I think that we're reaching a point right now where this is the peak. I'm watching what's going on in the interest rate market. I'm watching what's going on in the treasury auctions, and we're starting to see interest rates finally start to move up. And we were down to about 2.5% on a 30-year fixed at the bottom. Now we're back up around 2.9%. And essentially, I see this creeping up. We'll probably see 3 1/8, 3 1/4, 3 1/2. And this is going to have a negative impact on home prices. And at these levels, with the interest rates as low as they are, you will see a pretty dramatic impact. Now the market, and if you look at what's going on in the stock market and the fixed income market, it looks like the market believes that the Federal Reserve is just going to continue to let interest rates go up, and this is supposed to be positive for the economy and negative for precious metals and other things here. And I think that the market's going to get a wake-up call here shortly, because I don't believe the Federal Reserve is going to let interest rates come up much farther. I think they're going to come in with some kind of a quantitative easing program or some kind of a program to push interest rates back down. And so we're basically, they could let it keep going up. It's all political at this point. I don't believe they're going to let higher rates kind of start creeping up faster and faster. But I need everyone to understand that it creates an opportunity right now that you've got to take advantage of if you are lucky enough to own rental property or real estate that you have for investment purposes. At the end of the day, properties that are single-family residences, condos, right now they're being bid up. The prices are just outrageous. They're are selling for record numbers. And what's happening is, because you have such a large increase in the price, the rental market on these properties means that the return on investment is extremely low. So if someone buys one of these for a rental property, and once they get done paying all the property tax and insurance and homeowners association, everything else that goes along with it, their net cash flow is generally in the 2 to 3% return on investment. This is very low. And if we compare this to commercial properties, properties where people are investing in real estate in order to get a return, those are in the 5 to 6% return on investment. I have never seen a gap this big ever before. And it means that now is just the ultimate time to sell single-family residences, condos, and buy into commercial property. Now, obviously, if you don't have the capital to buy into a 20 or 30 or $40 million commercial property, what you have to do is use what's called a Delaware statutory trust. In 2004, the IRS approved these structures to allow for people to do a 1031 exchange on their single-family residence or their condo into a Delaware statutory trust and invest in commercial real estate that allows you to have a higher return on investment. And at the end of the day, I believe it's going to be much safer. The value of that property is based on the cash flow, where your single-family residence, your condo, that value is based on what people are bidding the price up for. And the reason that people are able to bid that price way up right now is because interest rates are being kept artificially low. It's really dramatic, and I really want you to understand the numbers. The numbers are that if you, let's say you have a $2,500 a month payment you can afford. Okay, you're going to buy a house, you have $2,500 that you can put towards principal and interest. Maybe with tax and insurance it's $3,000 a month. Okay, if you go to your realtor and say, Mr. or Mrs. Realtor, I need to buy a house. I've got $2,500 a month I can afford for principal and interest. How much house can I buy? Well, at 2.5%, that number is $632,717. Okay, that's what you can afford, $632,717. So that's a big number for $2,500 a month principal and interest. Now you know why all the prices are being bid up right now. Now, if interest rates go up to 3.5%, which is something that I believe is going to happen in a very short period of time. Now, someone that qualifies that can afford $2,500 a month in principal and interest payment, now they can only qualify for a $556,737 home. That is a dramatic drop, $632,000 to $556,000, same $2,500 a month. And you have to understand the numbers are identical. When you have $2,500 a month times 30 years, that's $900,000 in payments over 30 years. It's the same $900,000. If you buy a house at $632,000 at a 2.5% interest rate, you're going to pay $900,000 over 30 years. If you buy a $556,000 house at 3.5%, you're going to pay $900,000 over 30 years. It's the same number. Now, if we start extrapolating out and say, wait a minute, what if interest rates go back to 4.5%, which was a great rate just about a year and a half ago, 4.5%. Everyone was excited about this. And at the end of the day, that house is now $493,000. So $632 today, $556 at 3.5%, 4.5% is $493,000. That's the kind of drop that you're going to see because interest rates are so low right now. Higher rates are going to have a serious impact on what people can qualify for on loans. Now, if you really want to look at this thing, what if we went back to a really good interest rate in 2007, before the 2008 crash and all the government manipulation and driving interest rates down? A 7.5% mortgage rate was a great rate. People thought, hey, this is a good rate. I can't believe it's so low after going through the 70s and 80s and 90s. Boy, 7.5%, what a deal. Let's refinance. What can you afford with a $2,500 a month house payment, principal and interest? How much a house at 7.5%? That comes out to $357,000. So $632,000 today at 2.5 is the same as $357,544 at 7.5%. Now let's take a look at what's the highest that interest rates have ever gone. Well, back in 1981, the 30-year fixed rate went to 21.5%. At 21.5%, someone that can afford a $2,500 a month house payment, the house that they can afford is $139,301. That means a $632,000 house today would have to be worth $139,000 at 21.5% interest. You need to understand that the entire real estate market is being propped up by Fannie Mae, Freddie Mac, and FHA loans being artificially pushed down by the government going into the mortgage-backed security market and buying and driving interest rates down. Well, they already own more than half of all the mortgages in the entire country, and you can't own more than 100%, so this is going to end at some point. Now, my personal belief, and this is really just my gut feeling, is that once these rates creep up, when we get up around 3.5, 3.75 again on a 30-year fix, you're going to see a major negative impact on home prices, the stock market, and what's going to happen is the Federal Reserve is going to come back in and they're going to push rates back down again. It may give us another opportunity to sell. It may give us another opportunity to do refinances, but that's not guaranteed. These rates could keep going up, and the market thinks they're going to keep going up. They're not expecting the Federal Reserve to come in with another quantitative easing type program. I believe that they'll probably do it at least one more time, possibly even more than one more time, but that is not guaranteed. So you've got to take advantage while you can. The current home prices are really high, and you can essentially turn an income stream. I mean, we're seeing people double their income streams. If you're looking at a $500,000 equity, like a little condo, it's worth 500 grand. Great. How much am I getting? Right now, you're probably getting in the neighborhood of $10,000 to $15,000 positive cash flow on that property a year. This is taking your rent, minusing your homeowners association, any mortgage payment you have to pay, minusing your HOA, your property tax, all that stuff. Okay, so you're getting 10 to 15,000 net positive cash flow. That's after paying for everything. Well, you can take that same 500,000 and you can get 25,000 to $30,000 in a Delaware statutory trust right now. And this is property that I believe is a lot safer than owning a condo or single family residence. First of all, you're not responsible as a landlord to fix a bunch of stuff. If there's a plumbing leak, if there's a roof problem, if the renters don't pay because of COVID or whatever the story is, you're not responsible on one single property. When you buy into a Delaware statutory trust, you're buying into real estate that is owned within the trust as a fraction with a bunch of other people, and you're not having to deal with any of the property management. And these properties, I believe, are going to be a lot safer, even the ones that have had some challenges. Over the last year, the one challenge we've seen is in student housing. Obviously, a lot of the universities closed, and so a lot of those Delaware statutory trusts that were in student housing had a reduction or a temporary stop in the income from those properties. But we're seeing now all of the reservations and all of the students are returning back in fall, in August and September of 2021. We're already seeing like 70% lease rates, which is ahead of schedule for this time of the year. And so all that income is going to come back. All those people and all the ones that have had some challenges, University of Chicago, the ones there at Notre Dame, the ones at the 9 in Memphis University, Kent State, there's a few other ones there that have had some challenges. At the end of the day, all the other properties, the apartment buildings have all been paying. If you look at the independent care facilities, they've been doing fantastic, and that's a great spot to use DSTs, is to go into these facilities where you have senior care, memory care, that kind of stuff, and these people are pre-screened, and there's waiting lists of people to get into these properties. So you can sell your condo, sell your single family residence, and take that money, put it in, use a 1031 exchange, put it into a DST, and you don't pay any tax on all the gains from the capital gains because you're transferring it via the 1031. And now we're seeing doubling the income. We're seeing 5-6% return on investment. So when you're talking about 500,000, you're talking about $25,000-$30,000 a year in income versus 10 to 15. I mean, it's dramatic, the differential. And I haven't seen this before. It's the biggest differential I've ever seen. And it's not just, I mean, we got storage units, we got cell phone towers that you can use. We've got medical buildings, DSTs that buy into dialysis centers, all kinds of stuff. So at the end of the day, right now is an incredible opportunity to take advantage of these sky-high real estate prices and put your equity into something that's going to produce more income and is going to be safer. And the cool thing about real estate is you've got the ability to get a lot of tax-free income, tax-sheltered income. So when you look at tax sheltered income, what do we got? Well, we've got what's called a 20% pass-through deduction. This was under the Trump tax bill, where a portion of your profits could be tax-free. Obviously, it depends on the rest of your income and other things. You need to reach out to your tax preparer to see if you can take advantage of that 20% pass-through deduction, which is available on DSTs. Bonus depreciation is a new thing that they had under the Trump tax bill. Obviously, some of this might go away depending on what Biden comes up with, but those are the current rules. And the bottom line is you still have regular depreciation. You can still depreciate your cost basis against all of your income and receive a bunch of that income tax free. So we're seeing people that have a $500,000 condo where they're getting $10,000, $15,000 a year. Now all of a sudden they're getting $25,000, $30,000 a year, and this is tax-free money. And the thing that's so cool about this is it allows you to potentially do other things. If we have a property, we're able to increase a lot of income on a tax-sheltered basis from the DST, it may give us an opportunity where your income tax bracket's lower because a lot of the income you're using to spend is on a tax-sheltered basis. Now we have more opportunity to do Roth conversion on your IRAs or other investments. So later on down the line, you're able to take additional income out of those investments on a tax-free basis from the Roth IRA. So it just presents a lot of opportunities, but you should be looking into this. If you own rental property, if you have investment property, you need to take a look at doing this right now. Come see us. And share this with anyone that you know that owns rental property, because I don't think people really understand what the numbers are and what this is going to look like when interest rates start to really go up. Now, again, my hope is that this creep up in interest rates just in the last week or so won't continue. I think it's going to continue for a while, and then the government hopefully will come in and push the interest rates back down and give us another opportunity. But the window, I believe, is going to close relatively soon, because once consumer prices start to really go up at the grocery stores and at Home Depot and everywhere else, and people start seeing inflation really start to move into their everyday life and their consumer goods, you're going to have a lot of people screaming for the government to do something about the inflation and all the increase in prices. And we're not quite there yet. I do believe that government will come in, push rates down one more time, maybe two more times before the inflation really spikes up. But if people are walking into a grocery store and paying $10 for a gallon of milk, that's going to cause a problem. So, and at that point, the game's over on all this real estate and all this funny money that the government's doing and all the artificial suppression of interest rates and everything that's going on. So anyway, very important. Take a look at your current properties. Come see us. We can run the numbers. Now's the time to do it. Property values are going sky high, and you will see, as interest rates go up, a slowdown, and it gains momentum. What happens is, if the prices start to drop because interest rates are going up, it creates momentum. More people get nervous. They start, oh, I'm going to sell quicker. Oh, rates are going up. Oh, property values are going down. I got to sell too. And then there's a wave of people trying to sell and get out, and it just pushes everything down even more. So I don't want you caught up in that. Let's take action now while the opportunity is available to put you in a better real estate investment with more cash flow. So thank you for listening today, and hope you have a great weekend.